Hey everybody, welcome back to Dividend Stockpile and your daily dividend news. It's Tuesday, September 2nd, and we have a lot to talk about today, particularly in consumer packaged goods. Lots of shakeups, lots of changes, lots of things to know about, so stay tuned. Alright, so first up we have news that Elliott Investment Management takes a stake in Pepsi and sees a 50% upside for the stock. So, we'd love to see that as Pepsi, but it says activist investors' $4 billion stake comes as the soda and snack giant battles slowing demand and fierce competition. So if you scroll down a little bit more, get some more details about the particular change. It'll take a $4 billion position. It says that Pepsi can make the necessary changes and it could open up a path for a 50% stock price increase from today's depressed levels. Well, I totally agree with them that Pepsi's stock price is depressed right now. I hope this can revitalize the company going forward. So this activist investor, Elliott Management, is known for their major strategic changes, as it says here, at other companies. So we'll see how it goes for Pepsi. Scrolling down a little bit further, it says that they are confident that Pepsi can make the changes with some renewed focus on innovation, effective management, and portfolio composition. Something that Pepsi is going to have to focus on is the lower calorie, lower sugar options that most of the consumers are demanding right now. As most of us know, Pepsi has, Pepsi's, Mountain Dew, things like that. But also on the snack food side, it has Frito-Lay's, Doritos, Cheetos, not exactly healthy options. So of course PepsiCo does have some healthy options, but it's not what they're mainly known for. So hopefully this new activist investor can give it a boost on innovation and changes, and hopefully any kind of existing shareholders will see some upside in their stock. Looking at the stock today, it does look like it's getting a little bit of a boost. It was much higher earlier in the day, but it settled down for about 1.2% at the end of closing day today. So not too bad, but we definitely want to continue to see improvement. If you're looking at year to date, it's down about 0.9%. 1 year is down almost 13%, and 5 years is pretty much flat at only 5% increase over the last 5 years. So hopefully this new active investor can change things around, and Pepsi can continue to grow like it has over time. Looking at the long-term history, I mean, this is a complete winner except for the last couple of years. Moving on to the next thing, and this is probably the biggest news. Kraft Heinz Company announced its plan to separate into two scaled focused companies. Now, if you remember back in 2015, Warren Buffett orchestrated the combination of Kraft and Heinz together to create this particular company. Well, now they're talking about splitting it apart, and it's actually already got approval from their board of directors that they're going to make this change. So it's a done deal. It doesn't have to go to the shareholders. It doesn't require any kind of vote. But basically what they're doing is they're going to create two public companies with a portfolio of all their iconic brands. Their plan is to maintain the current dividend once the two companies split. So hopefully if you own shares of Kraft Heinz right now, when they do finally split, hopefully the dividend will remain the same as today. And they're going to break the company up in a tax-free spin-off way. So hopefully if you're an existing holder, there won't be any tax implications. Okay, so they're going to be creating two separate companies, which their names will be established on a later date. Now remember, this is going to be going to take a while for them to implement. They're talking about the end of 2026, so we still have some time to see how this all works out. But they're going to break it up into two different companies. One right now is called Global Taste Elevation, which obviously is a hilarious name, but it's going to have some of the most well-known things like sauces, spreads, and seasonings. It's going to include the Heinz ketchup and mustards and things like that, the Philadelphia cream cheeses, as well as the Kraft mac and cheese. And then they're going to have their North American Grocery Company. And it's going to include all the other things that you would normally see in the grocery store that aren't the sauces and spreads. So Oscar Mayer's, Kraft, Lunchables, things like that we're all aware of. Okay, so, anytime they do a split, they always have inside speak on what they feel like it's going to do. But they're going to, they say that they're going to allow to give the right level of attention to each of the brands. It's going to reduce operational inefficiencies. Right now, they're having to focus on so many different brands and so many different types of products that they're saying it's too hard to manage, which anyone could have told you that back in 2015. There was this whole empire building scenario where they thought bigger is better. Well, now they're reversing, and there seem to be more companies splitting off than that empire building that they've had in the past. Okay, so looking at the market's response to this, it's not very good. They're down 7.22% as of the close of business today. So again, a horrible day. It seems like the market does not like this split. Year to date, they're still struggling at negative 15.5%, and 1 year over 26%. So this company has been struggling for a long time. Hopefully this split up does create value for shareholders, and they can get to return some kind of results. But even looking at the last 5 years, it's down 25%. So this one has been a disaster for shareholders. Another shareholder that's not very happy at all is Warren Buffett. So if you remember back in 2015, he was the one that kind of orchestrated this combination. And so he basically said he's disappointed in the split, and he's also disappointed that it wasn't brought up for a shareholder vote. Now, he is the largest shareholder, and so in the article it did say that he'll have to determine his course of action in the future, but he's not making any moves right now. Moving on to a different consumer brand is Constellation Brands, the seller of Modelo beers and other kind of liquor and alcohol sales. It says they lower their sales forecast as U.S. consumers buy less beer. Well, anyone could have told you that. I was recently on the Dividend Talk podcast a few weeks ago, and I was talking to my friend Derek there, and I mentioned that in the United States, I'm really seeing a decrease in the amount of alcohol sales. And this just kind of reconfirms what I had said back then, that less consumers in the U.S. are buying beer. So let's look at the details. It says they're lowering their full-year sales and profit outlook, citing falling demand among Hispanic customers in particular. But I really do think it's pretty much all of them. So Constellation Brands sells things like Modelo and Corona, which of course are two popular Mexican beers. But overall, their entire sales are expected to go down over time. So they're looking at their net sales of beers to fall between 2 and 4% in the next fiscal year, and compared to a forecast of an up 3% increase. So that's a big swing, going from a 3% increase to between 2 and 4% decrease in sales. That's a pretty big hit to their sales forecast for something that should be pretty stable and predictable as beer sales should be. Looking at how the market's taking this one right now, it is not liking it at all. Negative 6.6% at end of day today. So the market does not like this result, and that makes sense because they're lowering their forecast. Looking at the year to date, they're down negative 31.5%, so it seems like the market was already on top of this. And the 1 year, they're down 37%. So again, not a great look for the company, reducing its sales forecast after a disastrous year already. So hopefully, this is a long-term play for some people and they will come back, but it's something that you are at the whims of the consumer on this one. And if they have less money to spend, or they're just moving brands to something different or something cheaper, you're going to be struggling here. So just keep a watch on this one and make sure it's something you want to hold long-term if you're a holder right now. Now let's get into some ridiculous news. It says the Nestle board appoints a new CEO following the departure of Laurent Fresse. And I apologize if I misspelled that. It's a French name. Now, this is quite ridiculous. You're the CEO of a global corporation. You're making probably $10 million a year in salary and benefits. And you get kicked out of the CEO role for having an inappropriate romantic relationship with one of your subordinates. I mean, how stupid can you get, really? So they're saying that they're announcing this new CEO following the departure of this other person. So hopefully the new CEO can get it together and focus on the company itself and grow the consumer goods brand over time. Looks like the market is shrugging it off with only down 1%, which is in line with the market today. This is the ADR for Nestle here in the United States. So we'll see what happens, but good for them for kicking them out. I mean, you can't have inappropriate relations with your subordinates, especially when you're the CEO. You need to rise a higher standard, if you will. All right, now let's look at McDonald's. And I have to say, it's about time. McDonald's has gotten so expensive over the last couple of years, it's absolutely ridiculous. When you can go to somewhere like Panera or Chipotle for the same price as McDonald's, you know something's wrong. Well, finally they caught on and says that McDonald's revives their extra value meals as it tries to woo budget-conscious diners. I don't know about you, but I'm not going to be paying $12 to $14 for a Big Mac at McDonald's. So they really needed to do something. It looks like they're going to try to. So it says it's announced on Tuesday that it's bringing back the extra value meal starting in September 8th, which is next Monday, including a $5 sausage and egg McMuffin meal and an $8 Big Mac meal. Now, those are in line with some of the other fast food places around, so that makes sense. But their current offerings on their menu right now are way too expensive, and it doesn't surprise me that McDonald's will be struggling. All right, so looking over to the market, it seems like the market likes them today. Again, on a relatively negative day, it's up 1.3%. So it looks like the choices of bringing on those lower price menu items has gone well for the investors public. Okay, well, that wraps it up for today. Really appreciate your time and watching on this Daily Dividend. Hopefully you got your daily fix of news for the market. Lots of stuff going on in the consumer market. Please leave a comment down below if you like this update that I'm doing every day. Make sure it's worth your time. All right, again, thanks for joining. Make sure you like and subscribe if you haven't, and we'll talk to you tomorrow. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.